This is a presentation for the Winnipeg Philatelic Society, Western Canada's oldest stamp club, and it's a presentation on taxes and stamp collecting and how taxes can affect you and your stamp collection. Now, this is a discussion of taxes in Canada, and it's going to be different everywhere else in the world. Now, in Canada, there are different types of income and different treatments of those income. And there's business income, which you might have if you were a stamp dealer. There are capital gains, which you might have if you sell a stamp from your collection. And there are dividends, salary, interests, etc., all of which are taxed differently, but probably don't apply. And it's complicated. So, if it becomes more complicated than you can deal with from the general advice given here, and perhaps by looking up these topics on the CRA website, which is not bad, you need to see your advisor to understand what you need to do in the detailed situation that you are in. It's complicated. Now, if you're a stamp dealer, you have a stamp shop, you have a storefront someplace, you have business income, and it is taxed at normal rates. Now that is, unless you are incorporated, that's a whole different topic and too complicated for here. But if you just have, you're self-employed, you have a business, you are a stamp dealer, you include that income in your tax return, it is taxed at normal rates, and it's determined as revenue less expense. And that's pretty simple. What you pay out and what you take in, the difference is taxable. Now there's some issues, inventory valuation. If you buy stuff, you have to value your stock at the end of the year. If you don't rent an office someplace, which I think is probably more common, your office is in your home, there are very specific rules for office and home. There are also rules for travel and depreciation. But the bottom line on all of this is you must keep good records. If you do not have good records, you are at the mercy of Revenue Canada. My experience is if you have good records, Revenue Canada does not spend a lot of time because they know there are lots of taxpayers out there with horrible records that are going to owe tax, and they'd rather deal with them than with you if you have good records. Inventory valuation. Each item of inventory, it can be valued one of two ways. You can either value each item at the lower of cost or fair value, or you can value your whole inventory at the lower of cost or fair value. Now there's lots of judgment in determining fair value, and CRA generally does not challenge those decisions. Now you have to be careful about this. For instance, if you bought a whole bunch of stamps, and the reason you bought the whole bunch of stamps was two stamps that you thought were worth $100 and you thought you could sell them for $200, so you paid $100 for the whole thing, and you sold those two stamps, you'd probably be fair in valuing the remainder at zero, not some kind of pro rata cost of what you paid for it. So if at the year end you estimated the fair value of all your inventory, Revenue Canada is probably not going to challenge that as long as it's within reason. If you are extreme in some way, Revenue Canada will come up with their own number. If you are within reason, by and large, they normally accept your number. There is a form T2125. You put your business on that. There is a list of expenses. It perhaps might remind you of some types of expenses to claim that you hadn't thought of claiming. And that's the form that you fill out. There's a total at the bottom, revenue less expense, and that goes on your tax return. You pay tax on it. Office in home. Revenue Canada is getting picky about this. You are allowed to claim a pro rata share of the costs of your office in home. So heat, light, power, mortgage interest, maybe not water, that depends. Depends if you have people come to visit you in your home and they're using the water. And it has to be on the part that is exclusively used for business. So you have to have an area in your home, a room, that is exclusively used for business, and then based on the square footage of that room, 100, and the square footage of your house, 1,000, 100 divided by 1,000, you can claim 10%. And again, there's a list on T2125. If you want to claim your office in home, you need to have good records, really good records. You need to be careful that there is a spot exclusively used for business. And if you do that and you do it carefully and you keep good records and you have lists of all the expenses you're claiming as costs of the office and home, you'll be fine. Travel, again, pro rata. If you are a dealer and you travel out of town to a stamp show, if you flew, for instance, the hotel and meals and airfare would be deductible. Meals you got to be careful with. If you are driving, then you have to have really good records about your car, and you have to have a mileage log. A mileage log is absolutely imperative. It is more than imperative. If you do not have a mileage log, Revenue Canada will just decide on a number, and there's very little you can do about it. If you guess 50%, they'll say 25. If you have a mileage log, and I had a colleague one time who just claimed 25% of his car, got audited, Revenue Canada said 10%, got to keep a mileage log. Next year, kept a mileage log. Goodness me, 60% of his car was deductible. And Revenue Canada never asked for the mileage log again. Now, it may or may not be worth the time to calculate. I found as I was approaching retirement and my business mileage was declining, keeping a mileage log, keeping all my gas bills, all my oil change bills, buying new tires, it was just not worth it, because in the end I was finding that I was claiming $100 in car expenses, saving $30 in tax. It just wasn't worth it. So I stopped claiming my car and I didn't have to keep a mileage log anymore, and I like that. Again, keep really good records. Travel again. Now there is a per kilometer allowance. Changes all the time. For illustrative purposes, let's say it's 50 cents a kilometer. It isn't, and there are a couple of different rates depending on the number of miles that are driven. It is a rate to be used by employees to determine how much they can receive and be non-taxable. So if the number is 50 cents and your employer reimburses you for 50 cents a kilometer based on you submitting a detailed record of how many kilometers you drove, it's not taxable. And if they pay you 40 cents or 30 cents, that's also not taxable. If they pay you 75 cents a kilometer, 75 cents a kilometer is taxable, and the employee has to keep track the same way and determine how much they can deduct. So some people think they can claim this as if they're a business. Technically you can't. I've seen people get away with it. Depreciation, capital cost allowance. Now, if you claim depreciation on something, it makes any eventual gain taxable, and it will either be fully taxable or taxable as a capital gain. Now, on a car, sure, claim it. You will very probably sell the car for less than the depreciated value. So the fact that you've been claiming depreciation all along probably isn't going to cost you any more tax. So sure, that's a legitimate expense. For your home, if you decide to claim capital cost allowance on your home as part of your office in the home, probably not, because that would make the sale value of the home partially taxable. The odds are you're going to sell it for more than you paid for it, and so you will recapture, pay full tax on any depreciation you have claimed, and then any portion that is a capital gain, you pay tax on half of it. The other problem with that is it is very difficult to determine how much your house cost. Now, you know how much you paid for it, And you probably know what the legal and accounting fees were that you paid, or real estate commission that you paid when you bought it. But if you put a picture hook in the wall and it cost $1, that technically increases the cost of your home. If you build a patio, that increases the cost of your home. So you have a very difficult record-keeping job to determine what the actual cost of your house is. Because if you just record what you paid for it, you're missing stuff. That patio has increased the value of your home. It's increased the cost base of your home. Now again, recaptured depreciation, fully taxable, capital gain, half taxable. So you need to keep really, really good records, and my inclination is do not claim CCA on your home, because you're just going to eventually pay tax on it. Now, self-employed and in business, there's a whole bunch of other things to consider which are too complicated. CPP, employment insurance, HST, GST, PST, and so on, maybe even workers' comp. It's too complicated to discuss in this module unless you are a very, very small business, and then maybe you don't have to worry about those things. If you're a bigger business, you need to talk to an advisor and make sure that you don't have an unhappy surprise somewhere down the line when Revenue Canada comes to visit. Capital gains. A capital gain is proceeds less cost. So you need good records. You need to keep track of your cost. The other problem is if you are selling stamps more and more and more frequently, when does it stop being a capital gain and taxable at a half? And when does it become a business and fully taxable? And there is no answer to that question. I don't know the answer. Somewhere in between a full-blown business with a shop in a shopping mall and selling a stamp for $3 at a stamp auction, it becomes a business. And where exactly that happens, very difficult to define. Now, Revenue Canada, or Canada Revenue Agency, doesn't like you claiming certain losses or deductions. So you have a thing called personal use property. Things that normally decline in value. A car. You buy it for $60,000 and you sell it for $20,000. And they're going to say, we're not going to allow you to claim a loss on a car. It's personal use. Now, if you bought a car for $60,000, a collector car, I don't know what it might be, and you sold it for $100,000, you have a taxable capital gain, and you have to record that and pay tax on it. And they have a complicated deemed cost and proceeds thing, with the cost is deemed to be $1,000 and the proceeds are deemed to be $1,000 if the actual cost or the actual proceeds are less than that. And the rule is if it is below $1,000, you sell something for $3 at a stamp auction, well, your deemed cost and your deemed proceeds are $1,000, but because it's below $1,000, you do not report that on your tax return. Revenue Canada doesn't want to be annoyed with that. Within personal property, they have a thing called listed personal property. And these are things that often go up in value. And listed personal property, there's a list, it's defined. Art, jewelry, coins, books, and stamps. Now, they intend to only tax the gains, and they don't like giving you losses. So if you have nothing but losses, you probably can't claim them, because you can only claim losses on listed personal property to the extent that in the past you have had gains. So you would, if you had losses, you would record them, you would carry them forward against the day that you had a gain, and if you never ever had a gain, you would never get to use those losses. So listed personal property gain is taxable at a half, like any capital gain. And as I said, a listed personal property loss, again, a half, but only deductible against listed personal property gains, and you may never have them. Deemed cost of 1,000 as before, or actual if higher, and deemed proceeds also of 1,000 or actual if higher. So you buy a stamp for $6,000 and you sell it for a net after commission and stuff of $10,000. You have a $4,000 gain, taxable at a half or $2,000. And as I say, this happens all the time. It doesn't. It's very rare that this happens. Now, if you were Bill Gross and you sold your collection of U.S. stamps for $25 million, like he did. Now, he's in the States, not in Canada, so I don't know what the rules are down there. But if he'd happened to be a Canadian, he would have had to have kept very good records of all the costs that were associated with him buying those stamps, and then know what that was and compare it to the proceeds. Because a lot of the stuff he sold for $200,000 more, up to $1 million almost. So you would need, if you're in that category, which I'm not, and most of us aren't, you have to have really, really good records. If you go the other way around, you buy a stamp for $10,000 and you sell it for $6,000, you have a loss of $4. You have a taxable loss of half of that, or $2, and that can only be claimed against listed personal property gains, which might be never. And again, this happens all the time. Now, if you sell 5 stamps for $3 at a club auction, technically each costs $1,000, so you have 5 stamps at $5,000, and your proceeds are 5 stamps at $5,000. So cost and proceeds are each 5. Your gain or loss is 0, unless it happened that you paid more than $1,000 for one of those stamps. CRA says, Canada Revenue Agency says, as it's under $1,000, you do not report it. So if what you're doing is at 10 club auctions, you're selling 3 stamps for $3, $4, $5, $10 each at the club auction, this is listed personal property. It's a listed personal property gain or loss. You probably don't know what you paid for the stamp. These are capital gains or losses, but they're under $1,000, so you do not report it. Now, another technical thing, this technically applies to a set. Things normally sold as a set, a chess set. So if you sold, I think there are 32 pieces in a chess set. Let's say there are. So if you sold your chess set for $32,000, you couldn't say, oh, each piece is $1,000. They'll go, no. That's a $32,000 chess set, $32,000 in proceeds. This probably never applies to stamps because stamps are not issued in sets. The people that sell them don't sell them as sets. We assemble things into sets. We individually buy stamps and accumulate a set based on the definition in the stamp catalog, but it doesn't apply. That is not something normally sold as a set, so it probably never applies to stamps. Now, how do taxes apply when you dispose of your whole collection? Well, taxes of course apply, but only to the extent that the purchaser is paying more than $1,000 for a single stamp. So if you were to sell your stamp collection for $2,000 and the purchaser said, I'm not paying more than $1,000 for any single stamp, taxes are irrelevant. You don't even put that on your tax return because they're all under the $1,000 for a stamp limit. Now, in terms of death and taxes, the only two things that are unavoidable, you are deemed to dispose of everything you own for fair value on death. So that will apply to your stamp collection. So if your stamp collection has a fair value of $2,000 and no single stamp is worth more than $1,000, nothing happens. So the only thing you really need to do for your estate is keep track of any stamp you paid more than $1,000 for. So the most important thing in all of this is, if you're anywhere close to the $1,000 rule, keep good records. And the second most important thing is keep good records. And you can guess that the third most important thing is keep good records. It's imperative. If it gets complicated, if it gets more complicated than this, if after watching this you go, oh, I'm only selling $3 lots, doesn't apply to me, fine. If it's starting to get more complicated, if you think you might be in a business, if you think you've got more complicated issues, office in home, inventory, these are complicated, see your advisor. The CRA website's not bad. It's their opinion on what the Tax Act says. Not necessarily correct, mostly correct. Most of the stuff on their website is okay. So it's not bad. And again, if you look at it and go, oh, I understand perfectly from the CRA website, I'm okay. Nothing complicated here. Fine. And as I said, club auction lots, it's probably not applicable. Occasionally I see a club auction lot go for $100. Don't think I've ever seen one go for $1,000. So, thanks for listening, but again, a disclaimer, these are complex matters, and this presentation may not apply to your facts and circumstances. And you therefore need to come to your own decision. You may not rely on this presentation. You need to go and see your own advisor.